Change is coming to Singapore's insurance offerings. New private insurance plan riders sold will no longer be allowed to cover the minimum integrated shield plan, or IP, deductibles set by the Health Ministry from 1st April 2026. It's a move to make premiums more sustainable in the long run and encourage prudent claiming behaviour. Nadine Yeam finds out more.
For 38-year-old Lim Zen Shin, health insurance was something that he barely thought about. Not until a knee surgery last month changed everything. After filing claims, he was told that his premiums would jump 200% at his next policy renewal.
I didn't really exactly know that the policy that I bought with the rider, of course, is actually a claim-based kind of policy. So for the past 10 years, thank goodness, I have been quite safe. I have not been admitted to the hospital. I does not require any insurance to pay out for any medical fees for the past 10 years. So the premium that I was renewing was relatively quite low.
The Health Ministry says more than 70% of Singapore residents have integrated shield plans, or IPs, for extra coverage on top of MediShield Life. Most add riders to reduce out-of-pocket expenses. The ministry says this increases the tendency for them to make claims, about 1.4 times more frequently than those without riders. Insurers who are feeling the strain have raised premiums up to around 17% on average each year to keep up with more claims. It's a vicious cycle that the Health Ministry is trying to tackle. To do that, it will be raising the co-payment fee cap. From the current 5% co-payment fee capped at 3,000 Singapore dollars a year, it will go up to $6,000 for new riders sold from 1st April 2026. This to keep pace with rising healthcare costs. At the same time, new riders sold won't be allowed to cover mandatory deductibles. It's the portion of the bill patients pay before insurance kicks in, and depends on the ward class they pick. The Health Ministry expects these changes to cause rider premiums to fall by about 30% on average. Take, for example, this person whom we have named Mr. A. He switches to a new rider plan in April next year. 3 years after that, he has knee surgery at a private hospital, which costs 56,900 Singapore dollars. Now let's study his medical bill. If he kept the old rider, he pays the 5% co-payment fee of 2,840 Singapore dollars that can be offset by Medisave. But with the new rider, he will have to pay the IP deductible of $3,500 for his ward class. The rider payout would be lower, and he also pays the co-payment fee of $2,670. While it may look like Mr. A will pay more under the new rider, don't forget, he already saved on 3 years of cheaper premiums. If it were $1,600 of savings a year, it would be $4,800 in total. The ministry says the idea is for people to save on these in the long run. The changes will roll out over 3 years. By 1st April 2026, insurers will launch new riders. From 27 November 2025 to 31st March 2026, they can sell existing rider plans to new customers. But customers must be told that these plans will switch to new riders by 1st April 2028. Existing rider holders are not affected for now, and insurers will review them later. At least one expert CNE spoke to believes the changes could also benefit young people.
So these people are young, they haven't bought into the insurance yet. And for them, what they will see is that the insurance premium growth will slow down. So if they were anticipating about an 8% insurance premium growth previously, now they can actually expect a slower growth. So over their lifetime, they will be benefiting.
Dr. Saxana thinks more people would make the switch to new riders or prefer public hospitals instead. But it could take time as they adapt and become more prudent with their claims.
Some insurance agents say policyholders or new riders might need to save up emergency cash to prepare for more out-of-pocket medical expenses. At least one believes most policyholders would take a wait-and-see approach before deciding to switch.
I'm going to start to have a few difficult conversations, as financial advisors. Because the first question that people ask is that I've been paying for so long, and this has changed, and I seem to lose my benefits. The downgrading of riders is a conversation that I'm already having with many of my clients, but more on the older generation clients because they see their premiums escalating very quickly in big quantum jumps, right? So they are thinking whether they can afford it.
I highly encourage like clients to meet their financial consultants and maybe start buffering the what is the potential out-of-pocket expenses to be made if things were to happen with the new rider. So they may need to relook into their savings, investments they are doing, if they can sustain this out-of-pocket expenses when things happen and in the long run when they are older.
The Life Insurance Association of Singapore, which represents the industry, says policyholders will be able to move to the new riders automatically without additional underwriting. The industry supports the change and it advises all policyholders to consult their financial advisors to ensure their plans meet their changing healthcare needs and budgets. Meanwhile, Prudential says it'll offer the new riders, but adds that other factors need to be addressed to tackle medical inflation. It says clearer fee benchmarks and more detailed bills from private hospitals will help insurers assess claims more efficiently and manage costs. Income Insurance supports the changes, but adds that long-term sustainability of IPs requires all stakeholders, including the healthcare sector, to play their part to address rising insurance premiums.